Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking about the U.S. economy, precious metals continuing to hold up, as well as some other topics that our good friend John Rubino sent us over. You can follow John on his Substack, which we will post to below. John, the first topic we'll get to here is more this wide ranging higher for longer term, dealing with the Fed, dealing with interest rates, where quite frankly, look, we haven't gotten any interest rate cuts, and the market has even shifted its perception of when we're going to get some cuts. And just look at where interest rates are. They are generally higher. 10-year, again, trying to maybe close in on that 5% level. Still some work to do there, but the more we're hearing from central bankers and the more we're seeing in terms of their actions is that we're not getting these rate cuts, and rates broadly are staying higher for longer. What's your takeaway from this, John? And carry that over to what it means for the markets, please.
Hey, Corey. Hey, Shad. Yeah, the Fed doesn't really seem to know what to do here, and it's not just the main announcements. It's what all the talking heads from the Fed say afterwards. So you get all these people saying, "Well, yeah, I think maybe we should raise pretty soon." Oh no, I think we're just going to keep it. They really, as a group, don't seem to have a coherent vision for what's happening, and it's understandable because based on their models, inflation was supposed to go away by now. They were supposed to be deeply into the cutting phase of this process, which is where they're way more comfortable. Nobody in a central bank in today's world likes to raise interest rates because tight money is just, it's damaging for so many of their constituents that it risks their future finance careers, if nothing else. And so right now the Fed is kind of at, okay, we're going to keep rates here. And I think that last time around they said our next move will not be a rate hike, implying that next time they do anything, it's going to be a cut. But they didn't say when, and they didn't say how much, and they certainly aren't going to do anything now because inflation is sticky at a high level. And there was just a survey that the results of which came out today, where they were asking people, what are your expectations for inflation? And that number went up from where it was in the last survey and is now around, I think it was 3% and change in the, I think it was a Zero Hedge article that I saw. But so you've got not just actual inflation, which depending on the number that you use, is 2.5%, 3%, 4%, all the way up to like 8% for some of the core numbers. And now you've got expectations that are kind of tracking the various inflation indexes upward. So the Fed obviously can't just come in and slam rates back down in this kind of an environment. But on the other hand, higher for longer until something breaks is really not a good long-term strategy, and that's kind of where they are now. Now, it's funny. There's an explanation for why things are a little stronger than expected, and we're not in a recession and everything. And it ties back into the basically hidden debt out there, the buy now, pay later thing, which is a new thing that is kind of an old play on the layaways that people used to do, where you decide you want a new dress and you buy it, but you got to make payments on it before you can take it home. Well, the new version is go ahead and take it home now, and then just make the payments. We'll break them up into 4 monthly payments or whatever. And that's a new source of credit, which is actually pretty good sized for a lot of sectors of the economy, and is giving people the ability to buy things they wouldn't have been able to buy before. And the credit rating agencies don't know how to calculate this, so it's not even being reported. It doesn't hit your credit score when you do one of these borrowings. So there are a lot of people out there borrowing basically with impunity. They can't take anything else out on their credit cards, but they do this buy now, pay later thing, and they can still spend money. And then on top of that, Freddie Mac is asking to be able to enter the home equity line market. In other words, what they'll do is when a bank gives you a HELOC, a home equity line of credit, Freddie Mac will buy that loan from the bank, securitize it, and sell it into the bond market. And that frees up the bank to make more home equity lines and so on. So we get yet another way for people to get unmanageably indebted out there. So they're trying hard to make us debt slaves, and temporarily at least, that's supporting the economy in ways that maybe was a surprise to the people who are engineering this stuff.
Well, John, when you think about how we came into this year, to your point earlier, there was a lot of worries that there would be a recession this year, and there was calls for 7 cuts, and then it fell to 6, and now it's fallen all the way down to 1, 2, or none by the end of this year. And to your point about inflation, it is stickier, it is staying a little higher, which is kind of getting in the way of them wanting to cut immediately, especially if inflation keeps trending higher. What would be the stimulus? And we've been asking this since the end of last year. What would be the stimulus for the Fed to start cutting if the economy is doing better than people expected, if the GDP is growing better than expected, if inflation is staying a little hotter than expected, and if the job market is better than expected? Why would the Fed start cutting in the first place?
Well, you wouldn't in that kind of an environment. If inflation's above 3%, you really can't cut interest rates in the face of that. And then all the other stuff that you just mentioned is kind of pointing in the other direction. And yet we've got the higher for longer thing. We're such a deeply indebted system that high interest rates are really debilitating for various parts of the leverage speculating community. And one way that we could shift gears in a hurry is if commercial real estate, which we've talked about a bunch of times on this show, blows up the local and regional banks. In other words, if a bunch of buildings get sold for huge losses and the banks have to report the portion of those losses that they've got on their balance sheets, and that spooks the depositors, and they just runs on the banks, and the government has to step in and bail them out. That's the kind of a scenario where you basically have to have the Fed cutting interest rates to facilitate the bailouts and to protect the banks from just completely imploding. So that could happen, and there's all kinds of geopolitical things that would make high interest rates untenable. If we get into some kind of a shooting war out there, which there are people in our government that really want that to happen, then you kind of have to have easy money going into that, because you'd see interest rates probably want to spike because of, if for nothing else, the inflationary impact of us getting into a shooting war and having to ramp up the military budget. And you don't want interest rates to spike and crash the economy while we're ramping up for a war. So they would ease in that case too. They would do something to push down long-term interest rates. And there are lots of other over-leveraged sectors out there that could just come out of the blue with some kind of a crisis. So there's still a lot of reasons to expect us to be in easing mode in the not too distant future. They just aren't linear. You can't just track the rising interest expense of a government or of individuals and say, okay, at this point, we tip over. But all of those things are pointing towards some kind of a big crisis, and it'll happen. We're not going to be in this situation forever. This is sort of an in-between place where we're waiting for the next big thing to happen. And in the meantime, we're building up all kinds of imbalances, or we're making existing imbalances that are already big, much bigger, and they will blow up at some point. So I don't know. I absolutely expected us to be tipping into recession by now, but I'm not ready to switch gears and say we've had a soft landing and we'll never have a recession. I still think something very bad happens, and the Fed is in easing mode in the not too distant future.
John, what do you think's holding up the markets then? Because with all the rate cut expectations, a lot of people are saying, oh, well, that's making investors move more into the markets because the Fed will have their back. But now we haven't gotten any rate cuts. We have far less expectations for rate cuts, but markets are pretty much right back to all-time highs, or at least very close to it. What's the investor psychology out there in your eyes?
Well, the investor psychology is that for the past, well, depending on how you want to think of it, either since 1971 or at least since 2009, buy the dip has been the thing you do. When stocks correct a little bit, you come in, you buy aggressively, and you focus on big tech as much as you can, and you're rewarded for it. So there are a lot of people in the financial markets who have never known anything else. And so that's the lesson that they've learned from past crises, is that don't worry, just buy anything that gets smacked. And at some point, the Fed's going to come in and bail you out. And it has worked. Those are the guys who've made all the money. And it is completely possible that they're right again in the next crisis, that the Fed will come in so aggressively that stocks, with all that liquidity, will flow into stocks again. But there's no fundamental justification for equities being where they are right now. This is the kind of valuation territory that usually precedes a gigantic crash. So no way would I tell people to go out and buy stocks aggressively right now. That just doesn't make any sense. Or at least, the broad stock markets, big tech and financial stocks, things like that. Go out and definitely buy the precious metals miners, but they're kind of a special beaten down sector that is actually undervalued rather than overvalued. But most of the stock market is it's 1999 again or 2007 again. It's those kind of valuation levels. It has never been a good idea to bet on those valuation levels being succeeded by even higher valuation levels. That's just not the way the markets have ever worked out. So I'll stick with history on this one, or that part of history on this one, and leave it to the buy the dip guys who've been watching that part of history, and they can do what they want to do. But I think this is a very dangerous time for equities, just based on valuation levels and what those valuation levels have meant in the past.
Well, John, just to that point, when you think about the mega cap tech leadership, it has been touted as the new safe haven. It's been touted as the new inflation hedge. And for the most part, investors have felt bulletproof because every time there has been a dip and they bought it, the stocks have ratcheted higher and higher. And despite a lot of people calling for, a big correction in the markets, it hasn't come. What is the impetus for those people to start seeing a sector like the precious metals as the safe haven or inflation hedge versus these mega cap tech stocks in their minds that are fulfilling that role now?
Well, yeah, that's another sign of a top. When people start talking about the dominant sector of the stock market as risk-free assets. You had the Nifty 50 one decision stocks back in the 1970s, and in each cycle, we've had a new category of financial asset that people have thought of as risk-free because it's gone up for such a long time. The human mind works in kind of discrete time chunks. 5 or 10 years is basically what we tend to look at and think of as the real world, just the way the world works. So whatever's happened recently, well, it's recency bias. Okay, there's a term for it. And whatever has happened for the last few years or whatever, we kind of choose idiosyncratically to define as recent history, that's what we think of as just going to happen forever. And once people get that mindset in the stock market, they single out the category of stocks that have done best during the time they've been paying attention. And they assume that it's always going to happen, which is another definition of risk-free, right? If something is always going to go up because it has recently gone up, then there's no risk in owning it. And you see variations of this all the way through financial history. There are books written about it. I think there was one called Dow 36,000 or something like that, where that was the thesis, that large cap stocks are basically risk-free forever, or they're so low risk that they're actually less risky than bonds, put it that way. And it's not a surprise that that mindset has taken over again, but that's another thing that never works out in the end because the world changes. And then the stocks that were bulletproof turn out not to be bulletproof, and they really tank. Remember the 90% club in the early 2000s? That was the formerly bulletproof tech stocks from the dot-com sector that went down by 90%. And Amazon was in there, Cisco was in there. A lot of other big names were in that category, that they were untouchable, and then they were down by 90%. So same thing's going to happen again, and we'll find out exactly how it happens and why it happens after it happens. In the meantime, there are a lot of people setting up with a much riskier portfolio than they think they have.
So, John, what are you looking for out there to confirm this whole market correction, almost crash is coming or recession is coming? What sort of data, what sort of market moves? What are you looking at that would give us that heads up that, okay, this fear is here?
Well, one thing that would start to do it, and that we're kind of seeing right now, is consumer spending starting to roll over. McDonald's and I think Walmart just came out lately and reported that their lower income customers are really pulling back because life is getting really hard for them. Those are the same guys customers who've been maxing out their credit cards for a while and who are in the buy now, pay later thing. So that always had maxing out credit cards always has a limited time frame in which it makes sense and in which it's possible. And maybe that's happening for a lot of people now at the lower reaches of the economy. Well, if that starts to spread into the lower middle class, let's say, and it starts to affect a lot of retailers, so that you get some bad earnings reports and the whole thesis that consumers are running out of money starts to take hold, that would do it. That would crack the stock market or the bank crisis. So if you look at what's happening with the banks, with, for instance, bank credit, the number of banks that are tightening their lending standards, that's already spiking. But if it continues to spike from here, if it keeps going up, there's a point at which that breaks the banking system, where banks are just so unlikely to lend right now that small businesses can't get financing and banks aren't taking on any new profitable assets. And so that leads to a recession too. So there are things out there that are kind of trends that are now in place that if they get a little bit more serious, at some point they'll be taken seriously by the markets. And then maybe the economy leads the stock market down, or maybe stock investors panic when they see these retail sales numbers and they sell stocks, and that causes the recession. It can happen with either part of causality there. But there's never been a time in probably human history, certainly in recent American history, where we build up these kinds of imbalances and then just kept on going. Eventually these imbalances become overwhelming and you have to stop. And again, I would have thought last year was when we had to stop. But sometime soon we will have to stop this. We'll have to stop borrowing as much money as we're borrowing. We'll have to stop buying stocks at outrageous valuations. And we'll have to stop trusting that banks are actually in pretty good financial shape when they're actually not. So bring those things together, or make them be sequential, or whatever, and you'll get a recession, and you'll get an equities bear market, and it just might not be on the kind of time frame that we think is reasonable.
Well, John, just tying that all together, do you think that kind of a market event, that kind of loss of confidence in the general markets, or at least a substantial correction, is what we need to see Western buyers come into the precious metals? Because there's no doubt that Eastern buyers, buyers in China and in Korea and Vietnam and Cambodia have been, and even in India, have been loading up on the precious metals, both gold and silver, in the recent past. Central banks have been loading up on it, but we haven't seen that Western influence, which obviously affects the resource stocks as well. Do you think we need that big corrective move in the markets to bring that buying in as the new safe haven?
Yeah, it is interesting that the East is all gold bugs now, and most people in the West are absolutely not there yet. But did you see the Wall Street Journal article of a couple of days ago? And it was kind of bemused, but it was a really favorable headline for gold. Something to the effect that, the new gold rush or something like that. And then it was a long article where they interviewed people in the US and asked them why they were buying gold. And the people told them gold buggy kinds of answers and things like that. So it was, kind of a very bemused article, because the writer apparently still didn't get it. But they're acknowledging the trend change. In other words, they're seeing interest in gold out there. And they're able to build a whole long article around that idea. So it's possible that that's a thing that's happening now in the US, even though interest in physical gold ETFs is not nearly as strong as it used to be. And coin shops and the US Mint, none of them are selling that many gold coins. Costco is, though. Costco's selling a couple $100 million a month of gold coins, which comes to a couple of $1 billion a year. And that's a pretty good chunk of new demand right there. So, I think the price of precious metals rising will get people's attention in the West, and they'll wonder what they've been missing. And, it could be that gold is already high enough, or if it goes up a little bit more from here, it reaches a point where we bypass the whole gold fever thing and go straight to silver. And everybody says, oh, look how many silver eagles I can get for one gold eagle. And they just move into silver, and silver just blows right past gold in percentage terms. So that's usually the tail end of a precious metals bear market when that happens. But gold has gone up a fair bit, and silver really hasn't gotten a big bid out of that yet. So it could be that that silver is the beneficiary of this new gold fever that the Wall Street Journal was pointing to, and that the Eastern central banks continue to be the whales in the gold market, while silver gets really popular in the U.S. It wouldn't surprise me to see that happen, just because the gold to silver ratio is so high right now. What is it? Still in the 80s, right? That's a level at which you usually, I mean, if you're a precious metals investor, you want to skew towards silver. And I think this is another one of those times when it's reasonable to do that.
Yeah, well, silver has been playing at least a little bit of catch up as gold has been flat. But hey, John, I think we're all waiting to see when that Western demand comes back and when the stocks start to get a little bit more love. But it has been a lot driven by the East, and quite frankly, the gold price, you cannot complain about that, while the silver price at least is moving back towards that 30 level, which a breakout from there, who knows, it could bring in some more investors. But clearly, one thing that even you outlined there is that investors still distracted by a lot of other markets. That might not change, but at least a little more allocation towards the precious metals that I think we have seen could also be a big boost for the sector. So who knows? We'll keep an eye open. We'll keep on chatting with you. Keep watching for this market crash, this recession coming that, again, could also change the narrative of investors. John, thank you as always. We'll post a link to your Substack, and we'll chat again in about a month's time.
Great. Thanks, guys. See ya.